All right, we're back for another episode of the YVR REMO show. Not always a fun topic to touch on this one, but it's definitely top of mind. We're getting a lot of questions around what does it look like to buy out a spouse? So in the event of a divorce, what does that process look like? How do we be prepared for those types of situations? And ultimately just partnerships. Maybe somebody that's purchased a home with another partner as an investment or a joint venture agreement, something of that nature, and we're now looking to separate from the asset and ultimately move on. So we're gonna touch on everything you need to know around buying out a partner or a spouse.
I mean, like you mentioned, it's a really hot topic. I think it has been for a while and it will continue to be. And, it's not all negative. We've helped a lot of people over the years that are just simply buying out a partner because, someone wants to move on. Two friends buy a house when they're 19 years old and 3 years later, they're just ready to do their own thing, right? So it's not all negativity. Separations are obviously a really hot topic as well. And, going through any type of a buyout or a separation, whether you're a business partner or if it's a family affair, the question that comes to mind is like, well, can I keep this property? Like that's typically how these conversations start is, we're either going to sell it or I might actually want to keep it. And can I actually qualify to do that? And if so, what does it look like? Right. And that's where the financing comes into play. So like Dean mentioned, we're going to touch on the spousal piece, the joint venture partnership, and then we'll also dig into a little bit of like a family and estate piece, like where a lot of people, maybe a family member's passed away or what have you, and someone really wants to keep that family home, maybe one of the siblings, and they're going to buy the others out. So why don't we kick it off, Tyler? If you want to kind of start, we can touch on the spousal separation piece.
Sure, the guy who literally got married 3 weeks ago gets to start off with the separation piece. So to Derek's point, like this, obviously, anything with a buyout means somebody wants to try and keep the home, right? For whatever reason, especially with a divorce. Maybe you want to keep the family and the property. Maybe you love the home, neighborhood. Maybe it's near a school. For whatever reason, you want to stick out in that property. A lot of people don't know that there's spousal buyout programs available, right? There's even a CMHC or insured mortgage spousal buyout program that's available where, when you consider a buyout, a lot of people, a way to kind of rationalize it, to think about it, it's like a refinance, right? You're refinancing the value of the home. The partner that's leaving is taking their chunk of equity to go live elsewhere. There's products in place that are set up specifically around this. So if this is something that you're going through, like the first step with anything to do with a buyout is always going to be a separation agreement, right? We can't even get the ball rolling until there's a signed separation agreement, until there's a value agreed upon. Maybe there's child support and alimony going either way, because those get factored in. If you're paying child support, if you're paying alimony, that's going to end up being a liability on your application. So that's going to reduce how much you qualify for. Also, if you're receiving child support and alimony, that's going to help you qualify for that income, right? So a lot of this stuff, for sure, you need a good legal representative to kind of help you through. In our experience, a lot of times the big question is just value. Like, how are you going to determine a fair value? And that's usually up for your lawyers and mitigators to sort of negotiate. We've seen over the years in people that I've helped, each get their own independent appraisal, maybe two, maybe three, and they kind of chop it up somewhere in the middle, or they come out to a separate agreement. So this spousal program, they're going to want to know the value of the home. They need to actually verify that it's actually worth what you guys are agreeing it's purchased, what it's actually worth. And then it's underwritten very similar to a regular purchase application. Your income, your debts, new application, credit bureau, all of that go into, a qualification. And if you qualify to buy the spouse out, they're going to get their net equity piece and take it on, to their wherever they're going beyond then. So
Yeah, I mean, you said a lot there, a lot of good stuff. I think one piece to touch on is, yes, you can't get the ball rolling from a firm approval process without having that separation agreement, but the separation agreement, you know, people get into these negotiations with their spouse. It's usually very heated in these types of times, and they're arguing and negotiating for things that they don't even really know what they're negotiating for. And so it would be prudent, if you're going down this path or you're starting the process to separate, to talk to us and look at your qualification prior. And no different than getting pre-approved before going out into the market. Just start to wrap your head around what might be important to you, because if you're somebody that is going to have to pay us spousal support payment, that could really harm your qualification in a significant way. We've seen this absolutely destroy people's qualification to the point where they actually don't qualify for anything. And so in some cases, you know, an individual like that could be arguing their wife or their ex-wife in that situation, or ex-husband in that situation, for, say, you know, a smaller payment amount opposed to a lump sum payment, where, you know, a lump sum payment could really help somebody avoid having a spousal support payment. So these are types of things that could help your negotiation and preparing for what's actually going to be required for you to move on with your life. And a lot of times there is, you know, well, not a lot of times, but we have seen this quite regularly where, you know, there is a pretty big amount of money coming out in the form of equity out of a property and out of other assets that they're liquidating to separate. And, you know, a big buyout number could be, you know, tough to swallow at that time. But boy, oh boy, if you could avoid a big monthly spousal payment and actually be able to finance and move forward and do things and grow your wealth in real estate or just anything in general, it's something to really keep in mind. And lastly, the one thing I can say just from personal experience with family, there's nothing worse than those individuals that have to write that check every month. Like, it's not fun. It's a reminder month over month. So just consider, like, if there is an opportunity to have a big buyout, opposed to a, you know, a payment, look at that, and you know, knowing what that does to your qualification is important to even be able to have that conversation.
We talk about this no matter what you're doing, whether it's a standard purchase or like a refi, anything, a renewal, is just having conversations with us as soon as possible so that we can start to run some at least ballpark numbers. And it might be just bluntly obvious that there's no chance you're going to qualify to do what you need to do. And if that's the case, all good, let's move on, right? Like, move in the direction that you're going to sell. And if that's the case, we can start to run numbers based on, you know, the equity that you might receive and what you might qualify for on a purchase, right? So I think just preparation is important. There's a really creative product. So typically, like, if you go to any standard bank and you're trying to buy someone out, the general rule of thumb when you're refinancing a property to pull money out is you can borrow up to 80% of the property value. So if you had $1 million home, and let's say there's a $500,000 mortgage on the property, technically the maximum mortgage that you can actually put on the property is $800,000. So there will be about $300,000 that you could potentially draw out for buyout or what have you. In a spousal buyout or separation type situation, there is an insured program. So because it's insured, it falls into the insurer guidelines. Property has to be less than $1 million, 25-year amortization. Qualification can be very restrictive. But there is a program where, if needed and if qualified, you can actually borrow up to 95% of the property value. They're basically treating it like a purchase, right? And it's just very creative, very unique, because a lot of times, depending on the equity in the property and the cash required for the buyout, you actually have to leverage more than that 80% threshold. So like I said, it's not going to be a fit for everyone. It's not going to work for a lot of people just because of how the CMHC guidelines, or insurer guidelines, I should say, operate. But if you qualify, it can be a great tool to keep that property and achieve the buyout that you need to.
Yeah, I mean, I would think of that as someone in like a new marriage, and maybe they bought with 10% down, and your immediate thought is, well, we've got to sell this. There's not enough equity. Well, there actually is a product there for you if somebody does want to stick in that home. So, you know, the other piece I would touch on, especially if you've gone through it and you've talked to your bank and now they're factoring in child support and alimony, there are a couple lenders out there. These are non-bank lenders that actually won't treat, like, if you imagine your child support or alimony is $2,000 a month, which we see all the time, that's a big, like, pull down of what you can qualify for. But there are some lenders out there that will take that income or that liability and move it out of your liabilities and instead reduce it from your income, which is getting a bit technical, but it actually, you know, can substantially increase what you qualify for. So I say that just to say, if anyone's out there who's run into that, you know, there may be programs for you. So, you know, other reasons why a buyout might work well for you if you can qualify, is, you know, it's going to be less expensive than a sale. You're not paying realtor fees. You're not paying property transfer tax. You're going to avoid all those closing costs because it's essentially just like a private refinance within your own home. So you're gonna save some dough that way. So, you know, we'll go over the other couple buyouts that we're going to talk about in this pod, but a lot will apply. So I don't know, maybe want to move on to maybe a joint venture.
Yeah. I'll just hammer home that one point though. Like, you know, especially if you have kids, if there's a way to keep the home. I know like that's always beneficial. That's a great point in regards to just cost, factoring those commissions and whatnot to sell the home is a big deal.
Any type of a separation or buyout can take a really long time. Like if you're not in agreement with the other individual involved or individuals involved, like you could be negotiating and arguing on certain factors, especially when it's financial related, for like years, right? So you do have to consider that if you're running your numbers now, hoping that this is going to close in 2 months, like there's a very good chance that if things don't go smooth, especially if it has to go through court, right, like a state or what have you, this could literally take a year. And like, look at what we've just seen. Property values can change in a year. Like there's a lot that can change. So I guess just going into it with an open mind that if you and the other party are not on good terms, the details of the deal, I would imagine, can change over time, right? Just because so much in regards to real estate and financing can change. I mean, even if you qualify for X amount today, but you're not actually taking on the mortgage for a year, like rates could have changed dramatically, and you could qualify for a lot less. So just keeping in close contact with your broker throughout that process, just to kind of adjust and adapt to changes as you go, is important.
Yeah, I mean, time is of the essence for sure. You don't want to stall in any type of transaction. So good points there. Well, let's jump into a joint venture partnership buyout. This is just the example here would be somebody that purchased a home with another individual for the purpose of, say, investing. We see this quite regularly where, maybe one person is bringing on like the qualification power, the borrowing power, and the other individual may be putting in the down payment. These types of, I mean, there's so many different structures here that we've seen. One thing before we just jump into what the buyout process will look like, it could be very dependent on your agreement. A lot of our recommendation for anyone that's buying in a joint venture partnership is to put together a co-ownership agreement. And the co-ownership agreement typically will spell out an exit strategy. Like that is one of the main terms in a co-ownership agreement is a proper exit strategy and how they're going to exit from a partnership, like whatever they have in place. So I would always defer to that first and foremost. For as an example, I've seen some where one individual is putting up the down payment, the other individual is putting up the borrowing power, and the co-ownership agreement will clearly define that the individual that put up the down payment is getting every dollar back from the down payment first and foremost. Every other dollar will be going back to paying off the mortgage balance, and then the difference in equity is ultimately what they would be splitting if they had a 50-50 co-ownership agreement over and above their investment pieces. So that's just one example. And then how to move forward from that perspective is now we know what we're buying out. It's a very similar process to what we just explained. If let's say the individual that's carrying the mortgage wants to maintain and keep the property, then there's going to be a very clearly defined number that he or she ultimately has to come up with to pay that other individual out. And there's a number of ways that we can go about it. We can, in this type of situation, the spousal buyout programs that we just talked about, especially the insured programs, wouldn't work in this situation. You're going through a full refinance. You're paying off the current mortgage, breaking it, and putting a new mortgage in place, or you're finding a way to assume, if both individuals were on the first mortgage, you're going to find a way to assume it and qualify to remove them. You may have an assumability clause in the mortgage that allows you to do that. You may just have to refinance just to ultimately remove that individual. Like that would be dependent on what type of mortgage you have and what lender you're with. And then to get that additional funds, you may not qualify for the additional funds. You could look at second mortgage options to ultimately get the additional capital, depending on the value of the home and making sure that the value of the home will support the higher mortgage balance. But the one thing to really hit home is these unique spousal separation buyout programs are just not going to be available to you. So the mortgage amount will not be able to exceed 80% of the value of that home.
Just to be very clear, like you can't be on title of a home and not be on the mortgage. Like everybody's on there together, right? You can't, it's not as though like, well, I don't need the mortgage, I have the down payment, so I'm just going to go on title. And so I bring that up to say, like, if you're going through or you need to go through a buyout of a partner on a piece of real estate, that person doesn't just leave for free. It's not see you later, right? The partner who is staying, the bank needs to confirm that they can qualify for that new mortgage or even the same mortgage that's there without that other party. So that's just a very important piece. Is it's a full requalification Just because you've had the mortgage for a while, you've paid it as agreed, isn't enough to let the bank just say, okay, see you later to your partner. We need to fully requalify you and make sure that you can carry that mortgage on your own. And obviously with rental support from the property, if it's a rental property, um, that just has to happen.
We've seen JV situations where someone's involved, whether it be cash or what have you, but like they're actually not on the property, right? Like maybe they have a lot of properties and that's their kind of restrictive issue. So, they're basically going into partnership with someone else, but they're not on title, they're not on the mortgage. So back to Dean's point about these co-ownership agreements and just the importance of like having that documented properly. And as one person's putting in the money and another person's qualifying, like how are you splitting the equity at the end of the day, right? We've seen people go into these and they have no clue that like they haven't even talked about it or thought about it. One guy thinks it's 50-50. The other guy thinks it should be more because he's putting in the cash, right? So just having a very clear conversation about what that buyout could look like will make your life a hell of a lot easier if it ever comes up. And I mean, just back further on that point, I guess I could say even to the spousal piece, right? Like if a couple are buying a property and one person's putting in 50,000, the other person's putting in 20,000, right? And maybe one person's paying for the bulk of the mortgage payment. Like as much as no one wants to talk about these things, whether it be JV or family or a relationship, like with a spouse, these are the things you do have to kind of talk about and think about and document. Because if it ever came back and this person's going like, well, I put in 50 and you put in 20, if you didn't document that or talk about it, you're probably going to be splitting everything 50-50, which may not be fair in one person's eyes, right? So I think just flushing this stuff out, like money is important. Everyone goes into partnerships and relationships with, the best intent, but you got to think about if it goes sideways, like how do you protect yourself?
Yeah, and I'll just touch on that piece. Like in the event that you did buy a property with another investor and maybe they're not on title, they just, their investment piece is defined in the co-ownership agreement. In those types of situations, you may not need to refinance. You could just add a second mortgage or a home equity line of credit, assuming you qualify to pay out their, agreed portion at that point in time. So there are a lot more flexible options if you're in that type of a situation. And I think at the end of the day, that we've seen so many different co-ownership agreements. We've seen so many different joint venture structures that if you're thinking about going through this type of a process, reach out to us as soon as possible. Let's look at the co-ownership agreement. Let's really understand what your structure is and how we're going to move forward, and then make a plan accordingly, because the plan will certainly vary depending on that structure. So why don't we move on to what a family estate buyout could look like?
We've seen it, maybe it's a parent who has a family home and they've passed away, and then they've willed their property to their children, right? And one of the children maybe wants to keep the home. It's similar to what we've already talked about in terms of qualifying and everything, but the big piece is just that will, right? Making sure that will's in place. I mean, we go through this all the time for people wanting to buy and their down payment is coming from an estate sale. But until that will has gone through probate, and if there is no will, well, then you're going to probably be on the sidelines for a lot longer than you plan to. So just understanding that will piece and getting clear indication and direction from your lawyer and in whoever's handling the estate of when that process will, get complete is kind of the biggest starting block to being able to action any sort of buyout, any sort of refinance. Obviously, we want to, you want to see if you can qualify for the buyout, number one. But the biggest roadblock that we come across is always that will piece, and has it gone through probate, and is the property ready to transfer title?
Well, if there's nothing clear documented on what each kid or family member is supposed to get, like that's where I've seen these situations actually go very sideways. And like, it's unfortunate. Someone just had a parent or parents pass away and they're going to be receiving money, but it wasn't clearly outlined. And now it's up to these 2 or 3 siblings that are quite literally going to start fighting, right? Because one person thinks that they deserve more because they looked after the mom, and you know what I mean? So I think just the importance of a will is key. As I sit here without a will, I should probably do that. The process, like the importance of a will, and then the process and timelines. Like again, if there's no will or there is someone, testing the will or trying to argue the will, like this stuff can take years and years and years and years, and it has to go through court, right? So just doing everything you can to try to avoid those situations for yourself, your kids, your family, I think is key. Again, like probate, right? Like it can take a very, very long time if anyone is arguing any component of it. So just trying to make it as fair as possible. And I mean, you think about that from a family dynamic, like you could have the best relationship with your siblings your whole life, and then all of a sudden, like your parents are gone, and it creates this issue that, to me, it just seems so unnecessary if you can avoid it.
Yeah, I mean, it's kind of like, I'm sure everyone's probably heard that saying, like, oh, it's stuck in probate, and whether they're waiting on an inheritance or there's a home on the market. We've seen homes on the market for months and months in very hot real estate markets, and people are like, why is that house not selling? And it's because it's stuck in probate. Like, they're getting offers, but the family can't agree on it. These are all situations that just drag on the process. And having a will, yes, it's very important, but not only is it very important to have a will, but it's important to continue to update it. Things change clearly, right? Especially with old age, and family members are stepping up, looking after family when others aren't. And to Derek's point, that individual might be looking for more money because or more support from the will or the estate, just because of their contribution. And in a lot of cases, like, you can warrant that, right? And so yeah, just continuing to stay on top of that is super important. And once you have a really firm will in place, you'll certainly avoid these probate issues.
Lawyers are expensive, right? So if you're going to fight over value, probate, all that, suddenly that inheritance piece just slowly starts getting whittled down over time, because people are arguing, right? So um, big piece, have a will in place.
Yeah, and then all of a sudden that extra money you were looking for it's not even there, right? So, just my last piece on this, and this is relevant in all these situations. Like a lot of times people will ask, like, do I need a down payment to buy this person out? So just to use an example of like $1 million home with 3 siblings, right? If it's $1 million home and there's no mortgage and everyone's entitled to equal share, technically each sibling's owed about $333,000, right? So if one sibling wanted to buy that property from the estate or whatever the situation might be, technically they have $333,000 of equity in the property. So like you're not actually putting any cash in that situation, and you would be looking for financing of about 666 roughly, right? And that would go to buying the other two out. You would end up with $1 million property with a $666,000 mortgage moving forward, right? Like the situations where you actually need to put cash in is if there isn't enough equity to pull out the amount that you need to buy the other person out. Those are the situations where there needs to be a cash component, and if there isn't a cash component, typically it won't work.
I mean, and that's a good example in a free and clear home, and with numbers just like that. Maybe you take a bigger mortgage to have some cash as well. You can, not only could you buy that home with output without putting any money down, but you might be able to get some of your money back as well. So instead of taking the $660,000 mortgage, maybe you take a $750,000 mortgage and you keep $250,000 in there, and you take some of the cash out to maybe renovate or upgrade because it was your old parent was maybe just not in the in the ability to renovate or what have you, and that's something you want to do, or maybe you want to use some of that money to invest or what have you. Like there are a lot of situations where you can look at actually getting some of that inheritance in addition to not having to put any money down. So good example, and it's a good segue into just determining the buyout amount. Family estate, just to summarize that piece, there's the buyout is really going to just come down to whatever was in the will or whatever, however it was structured in probate. But determining the buyout amount, let's really kind of hone in on this, especially from a spousal separation buyout piece, joint venture buyout piece. We talked about this briefly just in regards to getting multiple appraisals. Why don't we just start there and how the bank would look at that?
Well, actually, like the last one I did, it was a partner buyout, and they actually went and got independent appraisals based on zero bank guidelines, because and this is maybe a little bit lesser known, outside of the mortgage industry, is each bank has their own guidelines. I mean, they're all very similar, but some want to see comparables dated in the last 60 days, maybe some 90, some 120. All of those can kind of maybe skew values. Maybe it's not going to be very meaningful. Maybe it's like 1 to 5%. But if you're really wanting to make sure this is, truly and fairly done, the way we did it with these gentlemen was they each got an independent appraisal, never told the expected value to the appraiser, just wanted pure, like, what do you think the value of this home is? They each did 2. and then they met in the middle in terms of a value, and that's the number they worked with. They agreed to that, and they determined that for a fair value.
And I guess one other consideration when you're going through that process, because you can order an appraisal direct from an appraiser for personal reasons. Typically, when you're ordering it for a bank, it's actually a different structure. So just going through that process, like if you know you're dealing with one institution, you might just want to let the lender know, or even have the broker order it, right, from two different people. If you're at that point in the game, who knows if you are, but just a consideration is you might do an appraisal and you might actually not be able to use that specific report for financing if you're going to be going through that process a couple months later.
Yeah, and I think it's important to note too, like you and your partner may agree on a purchase price that's a lot higher than the appraisal, and just keep in mind, if you after getting the appraisal, if you can't come to terms on the fact that the house is just worth less than what you've agreed on, the bank is only going to look at the lower of the two values, and that's what they're going to finance on. So if you are ultimately going to move forward and keep the home and have to pay out based on the agreed purchase price, the bank's going to finance based on the appraised value. And in that situation, if you're dealing with a stubborn partner, you may just ultimately just have to go to market and sell it for what it sells for, as opposed to trying to agree with somebody that's not agreeable on actual value.
Yeah, I think just last piece for me on this is there is a consideration if you're planning to keep the property. I think it at least needs to be communicated that you're going to buy it based on value less mortgage amount, and then your determination on that person's equity. But you should also really look at the numbers. Like if you were to sell it, the real estate fees, like the mortgage penalties, the legal, all these different costs that come into play. And maybe you just decide to give them their fair share based on the appraised value, or maybe you try to negotiate it down, because if you were to sell, like there would be less money there for all parties. But that's definitely a consideration, to look at all your numbers and try to make as much sense of it for both people as possible.
Yeah, I think we kind of hit it all. I mean, never a fun topic in certain situations, but like we say with anybody looking to get any financing, the earlier you kind of get your numbers in line, kind of the better. So if this is something that might apply to you, get in touch with a good mortgage professional early, and get a will is my big takeaway.
Yeah, I mean, the biggest takeaway for sure is like a will, or just an agreement in place prior, right? Like especially around the joint venture partnership buyout. I think we've talked on this topic many times in the past around co-ownership agreements. Like it's just so important to have this stuff negotiated and agreed on prior to getting to this point. These discussions are far easier to have in the beginning than at time of exit. So we'll leave it at that. Thanks for listening. I mean, this was a topic that's come up a lot. This is why we're hitting on this topic. If there's anything you want us to chat about, please don't hesitate to reach out. Let us know. Happy to jump on any topic that's relevant to the real estate industry and the mortgage finance industry. So thanks for listening, and subscribe below.